Does your current premium finance company lock you into long-term agreements? That's because they don't want you talking to us. At IFS, we win your business the good old-fashioned way, with customer service. I know you don't always have to use a premium finance company, but when you do, you should use IFS. Cheers.
Hi there, and welcome to another episode of the Digital Insurance Pint podcast. This is our M&A series, and we have a special guest with us. But first, I'm going to introduce my colleagues, Steve Earle, CEO of Cheap Insurance, Jeff Roy, CEO of Excalibur Insurance.
Welcome, everyone.
And Adam Mitchell, CEO of Mitch.
Hello.
Guys. And very pleased to have Kenny Nicholls with us today. He is the CEO of Western. And hi, Kenny. Kenny, maybe you can just start us off here before we dive into the questions. Maybe just give us a quick background. How did you come to be a transplanted Quebecer living in booming High River, working in the insurance business?
Well, frankly, like most, I kind of never planned on being in insurance, but just ended up seeing the light and grew a liking to it. So about 10 years ago, I was working for Desjardins, who had just acquired Western, and I got tapped on the shoulder to see if I had any interest of moving my family out west. And so I came out here, met with Scott Dennis, and it was, we kind of, we hit it off pretty good. And who wouldn't? Scott's a great individual, great man. And so I decided to come here and give it a try. I came out here as the CFO, and about 6-7 years later became the CEO, and been enjoying every piece of it.
That's Kenny. How about Western Financial Group, Western? Tell us a little bit of background about the firm, where they came from, where they're going.
So I mentioned Scott before. In 1996, Scott acquired his first agency based in High River, and this is where I am today. And his vision was to actually bring markets to rural Canadian towns, because back then there wasn't much opportunities or much options for Canadians that lived in rural towns. And so he started with one acquisition to fast forward to I guess 26 years now. We're present in over 210 locations across the country. We're coast to coast, about 2,000 people. And I refer to my people as people, not employees. Employees to me kind of carry numbers and stuff. So I refer to them as people, because that's what they are. And serving about 1 million customers plus a year. We've got access to over 100 markets, and we were acquired 5 years ago by Wawanesa. A great fit, obviously a shareholder who's dedicated to the broker channel, so they let us operate as an independent broker, and we offer the best products out there for our customers.
Kenny, why should a broker sell to you? What's the elevator pitch you can give, all of us digital brokers and everybody across Canada that will listen to this podcast? Aside from money, what value do you bring to the table in a purchase?
Yeah, it's to me, it's all about the legacy you want to leave. These broker owners have spent their life building these successful businesses, and the last thing you want to do is kind of just cash in a big check, then walk away and kind of see your legacy being torn down, twisted, turned upside down. So essentially, what we promise is that we want to take over the business. We want to have the broker join the family. We rarely talk about acquisition or M&A. That's kind of a technical term. We talk about succession. We want to be seen as an owner's succession plan, and we want to move in and essentially want to continue the legacy that these people have built. We want to continue giving back to the communities, using the markets that they've developed, the relationship they've developed with markets. Obviously, we come with additional markets with our ways of doing things, technology. We've got 300 people dedicated to support our whole organization. So whether it's IT, finance, communications, marketing, you name it, we've got it. So these are all things that are kind of done in the background that normally smaller brokers wouldn't necessarily be able to gain access. But our primary objective is to not just kind of walk in and just take it over. We essentially want to continue building what the owners have spent their lifetime building, and try to do it a bit better. But sometimes it's kind of actually challenging, because we've acquired some very, very good businesses, but we always find a way. Obviously, we've got a number of markets, like I said, over 100 markets. It's quite hard for a market to walk away from Western, because we carry a lot of weight, and so it does allow us to weather some hard market storms, as we've seen in the past. I'm sympathetic to a lot of our smaller broker friends out there that the last 2 years have had a lot of issues finding capacity.
You had a clever line for you prefer to refer to your team as people as opposed to staff or employees. Is there a name for target brokers or future broker partners, or what's your lingo for that internally?
That's a good question. We're tossing it around between agencies, brokers. They are what they are. So not really a lingo for the targets per se. We can always refer to them as potential family members, because when we do sit down, we do talk about succession, having their organization join ours.
So what does a ideal potential family member look like, and what does that represent for size or geography?
There's no one. We've over the years, we've partnered with a variety of different brokers of different sizes that look very differently, whether it's geography, whether it's product. One thing for sure, we really look at culture fit. That is our number one criteria. We want to make sure that the owners feel as good about us as we feel about them. We find that allows us to hit it off pretty good at the very start, and that might be why we actually avoid bidding races, because that does not allow us to spend enough quality time with the owners and just try to understand the legacy they've built and how they're going about their business. Because we feel that if they've been successful doing it that way, there's definitely something for us to learn about, and we want to make sure we don't have that kind of drop off when we move in.
Great. So let's talk a little bit about about digital, right? This is the Digital Insurance Point podcast. So when you're looking at a couple of brokers, and let's say for sake of argument, they are the same, except one has a strong digital footprint or presence, whether that's front office or back office. Do you value that? Would you pay a higher price for that brokerage that's invested time, energy, and money into building their digital?
That's a good question, Tom. It's quite apropos, right? In the last few years, what I would say to that, though, I would actually first of all answer back with a question myself: is that digital strategy working for that broker? What I mean by that is we've been approached, or we've looked at various brokers who kind of say that they're digital. They've been able to attract customers onto their website, and they've got these fancy gadgets and fancy tools, but they have a hard time fulfilling the actual sale, or do they have the markets? Again, I think there would have to be, people don't. We've been approached by people like we're attracting this amount of visitors on our website a day. Given our size and our geographic locations, we've got a pretty good online search ability, and so our name kind of comes up relatively nice. And Adam, I think you would know a little about that. But essentially, are you able to fulfill? And so, if I'm going to buy or acquire or invest in a broker, in an organization that all they do is essentially attract customers, but then I need to invest in making sure I'm able to hold my promise to these customers. They've taken the time to kind of go onto my site, either complete a form, ask for a quote. I need to be able to follow it with action, and that's where I think a lot of the brokers that we've looked at, fall short. Now, some have very sophisticated systems that we've actually been very interested in, but then they kind of value, so we would attribute the value of the cost of the system, whereby the owners, though, see it as an overall business. But they either can't attract, like we've looked at some, they were spending millions and millions of dollars in advertising to attract customers. And is it actually working? Then they've got this sophisticated system. The customer goes into the system. They got no markets, or they have very little people to kind of complete the transaction. So my answer to that would be it depends.
So, Kenny, former owners or partners or whatever, you had mentioned, you said it investment at one point. So do you want them around? So I guess the question is, A, if it's an outright buy, do you want the previous principal or principals to stick around? Or part and parcel with that, do you do partial buys?
Yes to both. So obviously our approach is sitting down with the owners and kind of understanding what they want to do, where they want to go. Oftentimes, sometimes they're just not ready now, but they do want to try to work on their succession plan immediately. We've run into brokers who initially had an exit plan and that's fallen short, and they don't want to wait until they get themselves in a situation where they have to move. So they're forward looking, and so we can arrange that. From a former owner perspective, we absolutely welcome owners to stick around, essentially for as long as they want. But we actually normally would ask them to stay at least for 18 to 24 months. We've signed deals where the owners, once they receive their check, they just run out and you never see them again. And that's quite fine. It's important, though, for us to kind of understand what we're up against. The benefit of having owners stick around is it's a much better way for us to immediately get closer to the people that are there that essentially don't know us, right? So through the owner, we have that ability of instilling trust into the people, into the customers as well as the community. We don't pretend that people know us. And therefore, when we walk into a new community, it's important for us to try to, hang on to something that will allow people to still appreciate the business we're going to be running. So for an owner, now this said, the owner has to agree to no longer act as an owner. And sometimes that ends up being a challenge. But we're really upfront with these owners, saying, look, there will be changes, and we actually sit down with them and kind of take them through our integration plan. For various reasons, we need to make sure that systems speak to each other as quickly as possible. We want to consolidate market contracts. There's various things we want to do to allow us to be a bit more seamless and allow our value proposition to be able to be transferable to that new owner group. But without a doubt, Steve, our number one option is always we want to move in and just take control of the whole thing if possible, because that's easier for us. But if it's not easier or what the other party wants, we sit down and we try to figure out something that works. If you're giving me a path to an eventual full ownership, then we'll sit down and we'll make it work. We've got, like I said, we've got lots of people with a lot of financial and legal background. We can actually even help the owners kind of set that up as well.
That's good. Well, it kind of leads into my question. I think you've somewhat I'm guessing I know the answer, but we have to make sure we ask you. If you buy a brokerage, do they get to keep their name? And kind of sounds like to me that generally you change the name if they're model number one, where you buy them and take control. But if you have partial ownership, it sounds like you may allow the broker to maintain their name. Maybe explain how that would work.
As funny as it may seem, we don't have a one-size-fits-all approach for the branding. Our ultimate goal is to brand everything Western. Without a doubt, we all know how less expensive it is managing one name rather than multiple number of brands. But obviously, we have to recognize that brand for that community is worth something. And the last thing we want to do is erode value just because we've decided to go on an ego trip and just brand Western. Like I said, Western may not mean anything to the community members. And so in a case like this, we would have a plan to eventually work ourselves up. I remember many years ago, we acquired 11 branches out in the Cranbrook area in the interior of BC. And as much as we had lots of branches in BC, we were not known in that region. So a few years before taking over, we actually participated in the building of a new rec center they had, and paid for naming rights. And so for 2 years, people kind of knew who Western was. So it was a way for us to introduce ourselves into the community. It doesn't mean that we're going to buy into rec centers all the time, but my point is that we are very careful not to erode any value. And so, for example, the Wyatt Dowling Group right now out in Winnipeg is still branded Wyatt Dowling. We've owned them for a few years now, and we're working up to the time when we're going to be comfortable and branding it Western. So no size fits all approach, or not one size fits all approach, but a deliberate approach towards one brand for sure.
How should acquired teammates or employees think about Western, or what's in it for the acquired employees?
The first thing we do with the people is we make a commitment that none of them are going to go backwards in terms of total comp, right? And by total comp, I mean compensation, benefits, and the whole thing. Total comp might be allocated differently than it was prior, but essentially not one of them will be going backwards. If anything, what we've seen in the past is they end up earning a bit more than they were for various reasons. We've got a sophisticated benefits package, which normally we try to roll in, but there's a systematic comparison made prior and after, and making sure that nobody goes backwards. We make a firm commitment of that. We also make sure that all of the people essentially sign a new contract. We've kind of realized moving forward that it actually adds security to the people, because obviously they don't know us. Like I said, the advantage we have is we've been on both sides of the acquisition piece, right? We've been the acquiree and we've been the acquirer. And so it kind of allows us to also be able to put ourselves in the acquired person's seat and kind of know pretty much how they're feeling. So I think we've got a pretty good approach where we do reach out to the people. We have one-on-one meetings with them, make sure that we get to understand them and add the security they need. We've got some examples where that we were sitting down with people, and they were to announce that they had to leave because their better half had been transferred to Vancouver, and let's say that's in Manitoba or wherever. We said, well, we've got branches out there, so let's see where you're moving. And next thing you know, they're staying on board, but they're working at one of our BC branches. And so that's kind of something that people get to like. We've actually reconnected with former Western people that were now kind of when we started acquiring in Ontario, we ran into a couple of former of our people who are now working for Ontario branches.
So You mentioned that you have 100 plus carriers, and likely you're going to have more carriers than the brokers that you're acquiring. How do you manage the carrier relationships? Is there is there winners and losers in that?
Well, first of all, yeah, especially in today's world, who who in their right mind would get rid of markets? So that's kind of one thing to keep in mind. But to specifically answer your question, Tom, when we come in again, the volume that we represent, for any carriers that perhaps we're not that well accustomed to, there's an immediate it triggers an immediate call from them to us and say, hey, is there any opportunity for you to kind of bring us in your other branches? And so it opens up conversations. We feel that if these markets have been good to the broker group we're inviting into the family, we kind of spend time making sure that we kind of keep that relationship going. Most of the time, most of the carriers that the brokers will be dealing with, we already have a contract with. But it has happened where we've been introduced to new markets and we've actually added them. In the end, there are a few every once in a while that we end up seeing that we've got a better market for those types of customers. But that would not be a typical reaction. But I'd be lying to tell you that has not happened in the past. But it's we're talking about very small volumes here.
How do you figure out what a brokerage is worth in your mind? Is that multiples of EBITDA? Is that multiples of commission? A mix of both? And second part to that is, where are these multiples going in your mind?
Yeah, that is. So the answer to that is yes. I forgot to tell you at the introduction that I'm an accountant by trade. So it did take me quite a bit of years to actually see the light and really realize that insurance was more interesting than accounting. But no, not all of us are as quick. So it did take me a few more years. But valuation is really interesting. I feel that each broker group comes with its own specific value. Right now it appears to be trendy to kind of focus on revenue. And as much as I feel that is a part of it, operating profit or what we use in our jargon as EBITDA, so earnings before income taxes and depreciation and amortization, which is not even an accounting term, it just came to be as some type of operating profit, is a better representation of true value, because that's kind of it's the creation of value from the so how much profit dollars do you generate per dollar of revenue, which I feel is really important. When I came in the business 11 years ago, we were acquiring at 2 to 3 times revenue, or about 6 to 8 times EBITDA. When you kind of look at the trend right now, where we're probably trending 3.5 to 4.5 times revenue, and probably I'd say 10 to 13 times, if not even 14 times EBITDA. It's changed. There's a lot of capital out there. There's a real need for people to invest in brokerages, and there's various reasons for it. I personally feel that anything over 14 times EBITDA is starting to look like, my God, what are you doing as an investor? And if I were an owner, I would just be concerned that in order for that investor to make it viable, that what's the plan behind that in order for them to make it viable? Will they be looking for synergies? And when you look at a brokerage where about 75% of expenses are tied to people, you quickly realize that then, if you want to make it more profitable, unless by miracle you can start increasing revenue, you're going to be cutting down on people. And that might not necessarily be what you want, because then you've got service levels dropping. So it's right now, I have to admit, it is alarming to kind of see some of the multiples that are being paid right now. But at the end of the day, you know what? If good on the owners, if that's what they wanted, they wanted to get the highest price. I feel that as much as there's a broker group for every acquirer, there's also an acquirer for every broker group. And I think there's enough acquirers out there, consolidators as we call them, to kind of please everybody. So the word to owners would be just make sure you spend time speaking with the owners and try to figure out what is it you want, because sometimes part of the valuation is not necessarily in the price itself, but is the post closing. What's going to happen after, right? And will you be continuing my legacy or not? If it's something that doesn't matter to you, then price is all that counts. If it is, then I would say, make sure you get to understand who your acquirer is and spend a bit more time. A lot of advisors out there are obviously going to encourage their clients to get themselves involved in a bidding war. It shouldn't be all about price. No different than selling insurance shouldn't be about price. It should be about the value and the comfort we provide to our customers. I feel that M&A should be seen as the same as the same thing as well.
Great. Awesome insight on that, Kenny. It's really good to open up the hood and see how you see the market and how it's evolved. I know, back when I started, 2 times was kind of the going rate per revenue way back. Before Adam was born, probably. I'm so old, but anyway, is there anything to do besides you've got your valuation methods, but what other factors or levers can help that number? If you're going to get to 14 or maybe 15 times EBITDA or 4.5 times on the upper end, what can brokers do to make sure that multiple is increased? Is it, having a really high sales rate? If I'm growing at 25% and my EBITDA is 20% and I'm over that factor of 40, is that sexy to get the multiple up? Is if I'm super profitable and I'm getting some big CPC checks, not just over the last year when nobody's driving during COVID, but sustain. I'm a digital. What is there any levers? Do I have a group plan? What kind of levers can help brokers do to get that number up in the higher end?
Good, Jeff. CPC is definitely a good indicator of the quality of book that brokers have, and this is something that we really look at. We take a lot of pride in making sure that we provide good value for the markets we represent. And so it would be no different for, we wouldn't necessarily want to get ourselves involved with a broker who seems to be in the penalty box with most of its markets, right? That is something that doesn't necessarily show up on the financial statements. So you've got to know what questions to ask. You need to know what to look for. No different than we've encountered many owners who, 2 years prior to actually selling, knew that they were moving there and therefore they stopped spending. They stopped giving increases to their people. They start rolling books just to inflate commission. And these are things that any sophisticated buyers will easily pick up on. And we're going to normalize it back down, right, to what it should be, to kind of get to a more normal number. So I would say, definitely the health of the book, consistency are definitely factors that will allow us to perhaps pay top dollars based on what we see, helping us kind of understand where the opportunities lie as well. Sometimes undeveloped markets. So, for example, if we're looking at commercial brokers that are very light on employee benefits revenue, for example, or customers, well, we could see that as an opportunity. So each broker group may have their own opportunities, and so if it all depends on the market you're in, and whether or not we feel that we can kind of make a run at it. Because again, these multiples are all future values, right? You haven't earned that yet. It's all a question of what the acquirer feels that they can do with your business essentially then make a good return at it. So.
Just a little deeper on the CPC or the contingent, is that like 10% of revenue to 20% is a range you like to look for, or 5% of premium? How do you usually look at the CPC amount as in terms of a number multiple?
Any broker who'd be at 10-20% of their overall revenue with CPC is quite phenomenal, I would say. I think that normally the range would be maybe 5, 8, 9%. Obviously, the smaller broker you are, it all depends on the arrangements you have. But we've seen a lot of small brokers who unfortunately don't even have CPC arrangements because they don't have enough volume there. Right? So again, I would say it depends. And that's another thing. Not because you've got CPC would it mean that we would not. To us, that might be an opportunity, right? Where we bring you on to our contract. Next thing you know, your book is you've got a good book of business. We can actually leverage and then start creating CPC opportunities. But yeah, so I don't know what you guys are seeing, but I would I would jump on a broker who's able to generate 20% of its revenue through CPC. They must be doing something pretty good.
So Kenny, just for clarification, going back to multiples and EBITDA, when you say multiples in the 10 to 13, 14% times EBITDA, does that include or exclude CPC?
That's a good question. So EBITDA would include CPC.
Okay, because a golden rule with brokers has always been X amount plus CPC, which so just for valuation purposes. That's
a good question. It's if you look at it from a pure revenue perspective, then I think you've got to exclude CPC because you're looking at the growth potential. But from an EBITDA perspective, now we normally average out CPC. We don't necessarily just take 1 year. We're gonna average out 3 to 5 years out, right? To kind of, especially like the last 2 years, CPC has been artificially inflated for obvious reasons. So we, I think one needs to be a little careful about that.
How do the valuations in your book compare between heavy commercial lines brokers versus heavy personal lines brokers?
From a valuation perspective, it's really not difficult to understand that truly a commercial broker normally would be more efficient than a personal lines broker. Larger, less policies, larger dollars. So your infrastructure doesn't necessarily need to be the same. We look more at the opportunity. So the opportunity of converting your commercial book into personal lines business as well is definitely an opportunity. So oftentimes I might see that's why some acquirers might be favoring higher multiples for commercial business. There might be more opportunities there to grow, whereas a personal lines book purely has limitations to how much it can grow. Right? It's depending on how many brokers are there in that community you're looking at. If there's only a few of you and you already have 30-40% of the market, how much more can you expect to get? From a commercial perspective, then I think your opportunities are much wider because I know a lot of commercial brokers now are trying to tap in to their customer base and trying to get home and auto from that as well, especially in Ontario and Alberta. Might not be the same thing for the government auto provinces. And then you can expand through life, through employee benefits as well. So I feel that the opportunities to grow commercial are much bigger than personal lines.
So let me talk a little bit about possibly a fly in the ointment here in terms of a sale, right? We've been talking about how the seller sells the business, you buy the business. It's really a matter of fit and price and so on. But especially, there's a large number of rights of first refusal or ROFRS out there these days. And maybe just tell us what impact does that have on your desire towards a brokerage? And maybe just for the benefit of our listeners, maybe just quickly explain what a ROFR is, and then maybe you can tell me how you incorporate that fact into the conversations and discussions you have with your intended acquiree.
Okay. The majority of rights of first refusals we've seen or we've come across are essentially between a broker and a carrier. And essentially, at one point in time, a broker needed financing, got it from a carrier. In return, the carrier wanted to make sure that that broker would be supportive of that carrier, and therefore, it was a way for them outside the ability to invest in the equity immediately if the broker wasn't ready for that, or even the carrier wasn't interested at that point in time. It does allow carriers to kind of secure their volume with these brokers, and also allow them to either eventually move in and acquire if that's their strategy, or at least be able to allow or to choose on who would be acquiring. So it all depends on the strategy. We typically don't shy away from this. There's oftentimes there's a reason if a broker has approached us and is showing interest in us acquiring them. There's obviously either been discussions with the carrier already, or we would hope so, and maybe either the carrier's not ready or has changed their minds, and the ROFR is still there, but they're no longer in the business of acquiring brokers, and therefore the brokers finding themselves in a position where their succession plan is no longer what it was. In such a case, what we would do is as we're negotiating with the broker, we would make it very clear that in order for us to move in, they would have to sit down with the carrier and get complete release of the ROFR, right? And that would be then that just allows us to kind of move forward. And sometimes the carrier will want to talk to us and kind of say, okay, are you going to walk in and just kind of knock me out? Now, the good thing about when Western moves in is we've got a very good reputation with all carriers, and therefore carriers don't feel threatened when we move in, because they know that we don't move book. We will, and for a good reason, but otherwise we don't. So I've never come across a market that has felt threatened by us moving in. So typically we would have it waived and we just move. But that's how we go about it. Obviously, if the market doesn't want to move on that, and that's a different story. And yes, we might decide to kind of move away. But we haven't come across that yet. So I can't say we've had to sit down and kind of think about it.
Kenny, what's your end game? Like, how long is Western going to be doing this? Like, what's not you personally, but like Western's, is it conquer the world, be the biggest broker in Canada, expand into the US and the UK and maybe even Brazil, like some of our friends at IFC have done? What is the end game here?
We've always been a humble group. And so I like keeping it like this, because we're, although we are a big guy, we're not necessarily always seen as a big guy. I think I compare our end game to being recognized as maybe the Disney of insurance, whereby we want to make sure that people recognize us for the great experience and the level of expertise we bring to the table. We call that maybe dominating the Canadian landscape. We are focusing on Canada for now. We don't have any other expansion plans other than in Canada. I feel that just understanding the Canadian market in itself is quite complex in its time as well. So adding additional countries may not necessarily be up our alley right now. But as they say never. I would want I would want to get Western to a point where Canadians recognize the Western brand and associate it to a great experience. And as we were saying a little earlier on, insurance is often seen as a necessary evil by people. But I think we want to start changing people's minds on that. letting people know that, insurance is important enough that it allows you to drive your car legally. It allows you to mortgage your home, and then to safeguard the assets you've worked your ass off all these years to kind of pay. For people, the biggest purchase they'll ever make in their life is a home, and for some even a car.
So what I hear you saying is Western is not so cocky as to throw out a Brazilian dollar plan and advertise it that way. No.
Now, I don't know if you're looking at one of your colleagues, but like I said, it's kind of to each his own. We do want to remain top 5 in the retail insurance space, but essentially our will to dominate, I guess, would be just it'd be kind of brand awareness and for us to be recognized as, I'd like to be compared to Disney in our own realm. I do like some of the people, in insurance, making it so that insurance doesn't suck or something like that. Some people on this podcast here kind of use that often. I want to stay away from it because at the end of the day, insurance shouldn't necessarily be about price. Now, some insurance products can be about price. But we have a saying at Western that, insurance is complicated. Let's not make it complicated. We don't need to make it complicated, right? And so we're trying to make it easy for people, and that starts with our people. So recruiting the best people. We, quite proud to say that we're the first and probably the only right now a Canadian broker who's been named as top 100 employer in Canada. So that's kind of an important feat because we're in the people organization and we're in the people relationship business, people doing business with people. So knowing that our people feel highly engaged and will allow us to translate that onto our customers and make our customers feel great.
So huge thanks to IFS Premium Finance, our premier sponsor, and Crew Group as well. And also shout out to our charity partner, WIC. Thank you very much for all you guys do to support the podcast.
Is retention important to your brokerage? Of course it is. That's why at IFS, we have a cancellation prevention process. Want more details? Give us a call. I know you don't always use a premium finance company, but when you do, you should use IFS. Cheers.